All right, let's turn our attention to some disappointing consumer confidence numbers. They came out today. We've got a Taking Stock think tank to tell us more about the economic data and perhaps some new fears of a recession. We have Leonard Tannenbaum. He's the chairman and chief executive of Fifth Street Finance. Fifth Street lends to and invests in small to mid-sized companies. We also have Ward McCarthy. He's the chief financial economist at Jefferies Company. Ward is a former senior economist at the Federal Reserve Bank of Richmond. And also with us, Bloomberg LP's senior economist, Joe Brusuelas. All right, Joe Brusuelas, let me start with you. The consumer confidence numbers, where are we? Back 28 months, I think, in order to find the same level. Consumers pretty bleak.
That's right. We're back to the April 2009 level. And I think what we're seeing here is the result of, an interesting confluence of events, a long string of weak economic data, the policy tensions coming out of Washington over the debt ceiling debate, which really was a circus. And then we had, the asset volatility that we've seen over the past month. I think it's important to remember here that the transmission mechanism between asset volatility and growth is consumer confidence. And what we've seen today, what we've seen in the Bloomberg Consumer Comfort Index and in the University of Michigan Consumer Sentiment Index during the month of August tells us that the consumer remains strained, and it does not bode well for the economy in any manner.
Ward McCarthy, Joe Brusuelas, he talks about circuses, right? So I'm figuring got to have bread for the consumer if you're going to give them circuses. And he says that the transmission mechanism, this idea that people don't feel good about the economy, is really starting to seep into what happens in the economy. It's not just a feeling right now.
Well, we haven't actually seen it seep in yet. What we have seen is a variety of indices that say that consumers are concerned about the future, that businesses are concerned about the future. And we do know from history that when confidence collapses, like it has since the problems with the debt ceiling, that it does take something out of economic activity. We need to see the hard data for September. And frankly, I'm kind of worried about some of the data that we're going to see in September as a consequence of this deterioration in confidence right across the board.
Len Tannenbaum, come in on this topic. Happy birthday, by the way.
Thank
40
you.
years young.
Thank
So
you.
you've got a different perspective, right? I mean, do you think that the future really bodes so ill when we take into account the consumer confidence numbers? And also we could look at the housing numbers today and say housing prices, they're not going anywhere. What do you see talking to your companies?
Well, I'm usually an optimist. And we have 60 companies in the portfolio, over $1 billion in assets. And I got to tell you, July was slower. And August was a little bit slow. But what I'll say, as we're seeing, we look at weekly numbers. We certainly get a lot of monthly data. I think this is not going to fall off a cliff. This is slightly declining. And I think this is not the type of thing we saw in 2008, 2009. I think you're seeing a slowdown. And I think our hope is that you see a recovery at the end of the year, but we're watching the weekly and monthly data closely.
Do you get some indication from the companies that you have purchased their debt of that the companies that are in the consumer space are feeling the pinch of the economy a little bit more than those selling to businesses? You know
what's really strange is we're seeing a lot of consumer companies actually in the M&A activity. So the pipeline's very full for the fourth quarter. And it's full of a lot of consumer companies. It has a lot of food companies, as well as their normal mix of other companies. But we're very cautious, actually, to overfinance or over-leverage the consumer side of it until we actually see the turn in the consumer, which we haven't seen. We haven't seen it fall off a cliff.
Right.
And we haven't really seen the consumer have enough confidence to go out there and purchase a lot of goods.
You want to see the real bread before you actually spend some of it.
We definitely do.
Yeah, all right. We're going to Leonard Tannenbaum. We're talking during the break about Federal Reserve Chief Ben Bernanke and his speech, not at Jackson Hole, but previously, talking about how he's going to keep interest rates at or near these levels unless the economy picks up dramatically. But he says, don't think of any big changes until 2013. As a business person, this is a good thing.
Certainty, confidence, understanding what your cost of capital is. What that did was, first of all, it had me change my business, my lending business.
What did you do differently?
I reversed out a $100 million swap because I don't need it anymore. I don't need a swap when they tell you what interest rates are going to be for 2 years. And also, when we lend money, it's at LIBOR plus a floor. Well, now we know the floors have value because we know the Fed is going to keep interest rates at 25 basis points or 22 basis points on the 1-month LIBOR, London Interbank Lending Rate.
Thank you.
So I know you describe it if I didn't.
No, I love that. Thank you.
So look, when a lender has a certainty of both their cost of capital and the risk or the price at which we can lend, we can do more of it. And we can do more of it with certainty. We can help small business in a much better way. And businesses also have that predictability. So what Bernanke did by doing that is absolutely critical to keeping the economy going. The other thing, of course, it's set up is the ability to do QE3 twist, but your other guest can explain that better than I can.
The twist. All right, so what McCarthy, tell us about, well, first of all, do you agree with Len Tannenbaum? I mean, is it possible that we should be giving Ben Bernanke a little bit more credit?
Oh, I think we should give him a lot of credit because he has a game plan, and he's letting the game plan out gradually in a way that will, I think, get the maximum effect both on the financial markets and the economy. And the first step was to assure the markets that there's going to be a period of low interest rates. The second step is the Fed's going to change the structure of its portfolio by buying more longer-term securities.
What does that do? You buy long-term securities, you mean like debt of the U.S. government that's dated 30 years out, the long bond?
Well, it could buy probably not too much of that long, but they'll probably buy a lot more of 7-year, 10-year, and some longer-term maturities. And what they're trying to do is cause those interest rates on those securities to fall, the yield curve to flatten, and therefore help economic activity. And this is without buying additional securities. This is just shuffling things around. If they're not satisfied that this works, then sometime next year they could do a QE3, and that is start another asset purchase program.
Joe Brusuelas, does it sound as if this Ben Bernanke shuffle would work?
I'm a little uncertain. I don't think monetary policy right now is well positioned to support growth. I think that if there's an upset in financial markets, the Fed can take a range of actions to stabilize and then bolster the price of financial assets. But I think that the Bernanke we saw at Jackson Hole is probably the more realistic Bernanke. The Bernanke telling Washington it's got to get its fiscal house in order, and that the problems really that we have right now are in the housing industry and in the labor market, and the Fed really can't do much about that right now. And I think if I'm reading what they said today right, that there was really no support for lowering or reducing interest on excess reserves, mostly because Fed members don't think that there's enough demand out there for lending. If that's true, that really means the Fed's not in a good position to act right now.
Len Tannenbaum, come in on the topic of demand for credit. Is it there?
Well, first of all, I'll say, meeting with Wells Fargo, who lends to us $100 million last week, they said they're looking to put out money, they're looking to put out with partners they work with, but they want to lend more money. And the big banks all want to put out money, especially since they know interest rates are going to be down for a time. For us, we have $400 million of capital to put to work, and we're actively looking to put out money. The question is there demand for that? Are there healthy companies that can borrow and sustain and pay the interest on that borrowing? And I think you're having more and more of them. I think that they're recovering both through the cuts that they've already made, the personnel cuts, but also the adjustments in pricing. You've seen a lot of price increases, which means, by the way, in 2013, we're going to be talking about a lot of inflation coming through the system. And maybe that's why gold is rallying.
All right, but having said that, you also posited that the companies right now, whether they're trying to get money or not,
right,
you're looking for more indication that the economy is a little stronger before you commit to buying a lot of debt or
to lending
capital.
with private equity sponsors. Yeah, you're right. I think for the consumer sector especially, but for manufacturing, where I think the U.S. definitely has an edge here with the declining dollar, for technology, where we definitely have an edge in terms of our patent protection, but also just the absolute brilliance of our technology companies, we definitely want to lend. I think you have to be careful with the consumer, because I think the consumer here is very fragile. And unfortunately, the Fed really, I hope, does not watch the stock market only and try to manipulate what they do based upon how the stock market acts. I think they have the right tact in that they really have to think about, don't deploy too much monetary policy for the fear of inflation, and continue doing what they're doing. Certainty, clarity, confidence. That's what you want.
All right, and apparently, at least from your perspective, that's what Ben Bernanke's been giving everybody.
I'm a fan.
All right, well, maybe he'll send you a birthday present. Joe Brusuelas, tell us about the jobs report on Friday. What are we going to get?
Well, I think we're likely to have another weak report. The strike at Verizon is likely to impact this particular report. And we're starting to see some forecasts come in, most notably the forecast by David Ressler and Ellen Zentner at Nomura, who expect a negative payroll print. So we got risk on the downside. And I also, based on the data we saw today inside the the Conference Board's consumer sentiment report, the labor differential went up. That's jobs plentiful minus jobs hard to get, which suggests we may see a rise in the unemployment rate for the month of August.
Board McCarthy, how are we going to make Joe Brusuelas more optimistic about the economy? I mean, you're looking at the jobs report. Is it really going to be this poor?
It's not going to be good. We're only looking for an increase of about 30,000 total, 70,000 in the private sector. And Joe's right, the Verizon strike will take out 45 grand roughly this month and add it in whenever the strike ends. But we are right now in a little bit of a down spot as far as confidence is concerned. And it's a self-inflicted wound. This is all due to a policy mistake in Washington. So as time passes and people understand this is not the end of the world, confidence will start creeping back into the markets.
And what was the big policy mistake in your mind?
That was the way that Congress and the White House handled the debt ceiling. They mishandled it. They had an inadequate deficit reduction package, and frankly, we deserved a downgrade. But we could have avoided it, and that's what I think has the American populace really in a stew right now.
Leonard Tannenbaum, I mean, does something like that really affect your business outlook when you see the debate or the lack of consensus in Washington over the debt ceiling? Does that have a lingering effect on your decision-making process?
It wasn't just the debt ceiling debate. It's what happened to the financial markets. It's what happened to the perception of what was going on, and remember, certainty, clarity, confidence. That's
right.
What,
Ben
that's what we
Bernanke's doing
need.
that, but the Congress isn't.
Congress
and then he comes out of Jackson
away.
Hole and says,
Congress took
you
it
guys
away.
got to come up with your game.
Absolutely. Congress has to get its act together. They have to make a clear path with taxes, with tax reform, with corporate tax reform, and all these important things. Give us a path, not just gridlock. Tell us what is going to happen. Tell us what's going to get cut. I mean, even when you're looking at when we look at an education company to finance, our Pell Grant's going to get cut. We know that's on the table. We know that's a pretty juicy morsel for Congress to cut as part of the $1.4 trillion. Will they cut those? So we need certainty, and we need it soon. This better not drag on till the end for the cuts.
Well, they're not supposed to release their report. I think they got a Thanksgiving deadline. So what do investors do right now? I mean, so what do you do with your money?
You put it in good yield.
What do you do? I guess I
us.
should ask you, what are you doing with your money? That's even better. What are you doing with your money?
Look, I've always had the philosophy that you put all your money where your mouth is and with your shareholders. I recently purchased $2 million worth of stock in my own company, one of the largest shareholders. It's most of my net worth. And look, where else am I going to get a 13% yield? I actually own some of my competitors even. I think our whole industry got broad brushed. And
these are business development corporations.
Business development corporations. You got to look for yield. You had Microsoft on earlier. I mean, that's not bad at a 2.4% yield. You just have to look for safety and yield. And you also need, obviously, diversity. Unlike me, who are going to invest only in my own stock, you really need diversification in your portfolio. But you got to be careful, because if Congress doesn't come together and you have another external shock to the system is fragile. I think it's fragile.
Board McCarthy, same advice that you've been talking to clients about? I mean, be a little bit defensive, but don't completely ignore the possibility of, let's say, investing in dividend-paying stocks.
Well, I like dividend-paying stocks myself. I also think that some of the financials, like Lens, for example, did get broad-brushed. Jefferies is another one.
I was going to say, Jefferies, we've been talking about this, right? I mean, like, how do you get, $16 a share, and yet Len was just talking about how Jefferies is doing so much M&A activity in the mid and small-sized companies.
Yeah, no, it's a great buy at that price. And I also think that investors should start thinking about moving into some real assets. You know, people don't even like talking about real estate these days, but there are some great buys out there, both on the residential side and on the commercial side. So, you know, it's always hardest, whenever it's hardest to make an investment decision, that's usually when it's the right time to make it. You know, given the caveat that we just have to be careful Washington doesn't blow us up again.
Joe Brusuelas,
inflation comes back, right?
Yeah, inflation. That's what I wanted to ask Joe Brusuelas about, inflation, Joe Brusuelas, because we were looking at the consumer spending numbers yesterday, and then you had to factor in the core deflator. I guess that's a fancy term for it. Factor in inflation, and it's not as if people are making any more money.
No, they're not. You know, if you looked at those income numbers in the report yesterday, that's the July personal income and spending report. If you exclude government transfers, income didn't increase. And if you looked at income on an inflation-adjusted basis, income actually fell for the month. That's why in the FOMC minutes today, there is a decidedly downward bias in terms of where the Fed expects inflation to be. Core inflation will probably rise through the end of the year, and then the overall economic slack in the market, and specifically the extraordinary amount of labor slack, will begin to bite, and it would not be surprising to see a bit of disinflation in the core in early 2012.
All right, gentlemen, we're going to leave it there now. I want to thank you very much. Joe Brusuelas joining us, Bloomberg LP's senior economist, Ward McCarthy from Jefferies, and also Len Tannenbaum from Fifth Street Finance.